No, we believe that central banks, the three central banks this week will not change their rates. So basically, this week we are not expecting any cut or any hike by any of the three central banks, basically. And this actually is in line with market expectations, as if you look at the market probability of having changes in the main refinancing rates of central banks, the market is not expecting any as well. So Neuberger is in line with the market expectation of no movements in the main three central banks rates this week. So for the three main central banks, we are expecting for ECB, we are expecting two cuts of the main refinancing operation rate in 2026, whereas the market today is expecting three hikes. For Bank of England, we are expecting between 0 and 1 cut in 2026, whereas the market as of today is expecting around 2 hikes. And finally, for the Fed, Neuberger is expecting between 2 and 4 cuts in 2026, whereas the market sees no action today. So generally speaking, Neuberger is more dovish than the current market assessment of interest rate movements by the three central banks in 2026. Generally speaking, our view is more dovish than the market view, right? That means that if this scenario actually materialize, rates will come down from current levels. As the market today is not pricing this scenario, as market is mainly focused on inflation and the energy price shock that are actually driven by the current geopolitical conflict in the Middle East, what is going to happen if our scenario materialize? If that's the case, actually, interest rates throughout the world will have to come down. And if that's the case, this decrease in market interest rates will have a positive impact on fixed income, right? Because, price of fixed income securities are inversely correlated to interest rates. So if that's the case, there's going to be a very positive impact on the price and valuation of fixed income security. So to cut a very long story short, this will have a positive impact on fixed income. But we do think that the main positive income will be on the short part of the curve, as the market pricing of interest rate movements is much more important on the short part of the curve, which is directly impacted by central bank interest rate direction rather than on the long part of the curve. So if our scenario will materialize, we do think that the short part of the curve, which I mean 0.2, 0.3 years, will have a very positive impact by these rate cuts in the next 12 months. There are a couple of reasons, I think. The first one is actually correlated to the short part of the curve yields that we've reached over the past 2-3 months. With the Middle East conflict escalation and the energy price shock that we are living due to the fact that the Strait of Hormuz is closed and the oil is not passing. Remember that 20% of the global production of oil is going through the Strait of Hormuz, so there's been a very big energy shock. The short part of the curve in the global market rates has been gone up, especially in the European market. So if you look at the short part of the European rate curve, has been going up massively. That means that the yields that you can achieve on the 2-3 year part of the curve today in Europe have gone up by 60 or 70 basis points in few weeks. That means that the current yield that you can lock in by investing in a short duration strategy is very high compared to the beginning of the year. To give you an example, our short duration Eurobond strategy yield has gone up from 3% to almost 4% in few weeks. So if you invest today, you have a very high yield. Another point on the interest of the short part of the curve is that today we have a lot of uncertainties about government fiscal plans and fiscal expenses in Europe. And that is actually that these fiscal expenses that government have to put in place or will have to put in place might have a negative impact on the very long part of the curve. So basically, if you buy today duration on the very long part of the curve, you might be exposed to future weakness in case European government adopt a very proactive fiscal policy, and they will make a lot of spending to help the economy. And why is that? Because governments, when they do that, they usually sell long-dated bonds, and the fact that we might have a lot of issue of new long-dated bonds could put pressure on the long part of the rate curve. So there are two main reasons to invest in the short part of the curve. The first one is valuation, because you have a very interesting yield. And the second one is protection. Protection of what? Protection of government expenses on the very long part of the curve that could put pressure on this part of the curve. And while we think that the short part of the curve is more protected in this environment. Yeah, sure. It brings to investors the potential of good performances in case the Neuberger scenario realizes. The Neuberger scenario is that we are having cuts, especially in Europe. Remember, in Europe, we are expecting 2 cuts in 2026, whereas the market today is almost expecting 3 hikes. So there is quite a lot of difference from the market current pricing and Neuberger expectations. We do believe, of course, that the cuts are coming because of the fact that we are seeing a weak European economy, whereas the market is just concentrated on the energy shock and the impact on inflation. We are seeing a weak economy that has been witnessed by the very recent macro data. For example, last week, Germany reduced the official growth forecast from 1 to 0.5%. Citing the war impact. And also last week PMIs were definitely on the weak side. So we have various reasons to expect that there's going to be cuts in Europe. And how this will benefit to portfolios? Well, short duration portfolios today are actually yielding very high level of yields because of what we said. Because over the past 3-4 weeks, there's been a flattening of the rates curve, whereby the short part of the curve has been increasing a lot in terms of yield. So if the Neuberger scenario realizes, this part of the curve will have the most benefits as it will be mainly impacted by cuts. So if that's the case, investors in the short part of the curve will get the most benefit of the expected scenarios in interest rates, just because the short part of the curve will be the most impacted by cuts in 2026. So the fund today is at its max long duration. As you might know, this fund is a flexible strategy that can use a duration range going from 0 to 2 years. Well, today we are very close to 2 years. And why is that? Because we are expecting cuts from the ECB. So we think that the current pricing of rates in the short part of the curve is wrong, meaning that this part of the curve should come down. And if that's the case, this will have a very strong positive impact on performance over the next few months. So this is our positioning on duration. As far as asset allocation, the fund today has around 65% in credit, mainly investment grade credit, only a small part in high yield. Then we have about 15% in European asset-backed securities. The vast majority of those are first pays or second pay tranches of granular portfolios. We don't buy single loan CMBS or CLOs because we don't like to take concentration risk in the portfolio. We have also around 12-13% in government bonds, where we have also a nice exposure to Eastern Europe countries' government bonds, as we do believe that there's going to be convergence between spreads of Eastern Europe and Western Europe countries. And last but not least, we have also a nice exposure to cover bond at around 8-10%, as cover bonds today are a rate product. And again, we like this environment of rates whereby we are expecting cuts. So if there are cuts, cover bonds will be actually benefiting from cuts. A last point on the recent changes in the portfolio. Maybe it's interesting also to highlight the fact that we took advantage of the month of March spread weakness to increase our credit exposure by 5-6% of the portfolio weight, and we've been selling asset-backed to finance this switch. We've been selling asset-backed because those are floating rate notes. So asset-backed in the portfolio were almost not impacted by the rates weakness of the month of March. On the other hand, IG credit fixed coupon bonds was impacted by this weakness. So we sold a part of the portfolio that was not impacted by March weakness and bought in credit and fixed coupon bonds that were impacted by March weakness. So we've been adding risk at the margin during the month of March, and we've been keeping very high duration. Maybe a very last point on duration. In the month of March, European interest rate curve flattened a lot, meaning that the short part of the curve moved up much more than the long part of the curve, and we implemented the curve steepeners in the fund, both steepeners between the 2 and 10-year part of the curve, and also between the 5 and 30-year part of the curve, as we do believe that with the geopolitical de-escalation in the Middle East, this curve should normalize and steepen again. If the curve steepen again, we will be making money on the steepener that we've been implementing in the month of March. So this was very long story to give you the portfolio positioning, but yeah, I think it's important to highlight that we managed actively our risk, both duration risk and spread risk, in a volatile month of March. And this active management is one of the peculiar characteristics of the fund that allow us to constantly produce alpha independently from the market environment.